Hi everyone, this is Lee and welcome to Grizzly Bulls. Today we're just going to talk a little bit about what the markets did last week and what we can learn and maybe imply or use in our trading for the coming week. So this week, the market started off pretty strong, as you can see in most of the charts. Monday was kind of a breather, and then people got excited that we might have put in a higher low. About 44.71 was the low on Monday, and then Tuesday and Wednesday was a nonstop surge for every index, especially even the NASDAQ, really outperforming on Wednesday. Unfortunately for the bulls, on Thursday, the CPI report came in with a 7.5% inflation rate, which was higher than the 7.3% expected. And that accompanied by a few of the Federal Reserve members' hawkish comments indicating that probably the March meeting we are going to have maybe 50 basis points hike instead of 25. And some even calling for a 1% Fed funds rate by June. Was much more hawkish than the market was previously anticipating. And that ended up for a pretty bad Thursday, especially for the NASDAQ down here. Friday was even worse, and it started out, kind of just continuation of downside momentum from the same reasons as Thursday on the CPI and inflation, interest rate hikes, and all that stuff. But definitely was exacerbated by some Russian warmongering fears. So we'll see what plays out there over the weekend. If Putin backs down or whatnot, we'll probably get a pretty decent bounce on Monday. If it's still kind of uncertain or if anything takes place over the weekend, then we'll have continued declines. For now, the momentum lies back in the court of the bears. It's still a long way down to the lows from late January. The NASDAQ is by far the closest, as it has done terribly over the past few months. It's the NASDAQ correction so far from the November high to the late January low was almost a bear market, about 19%. It was only about 10% for the Dow, and it was about 12.5% for the S&P 500. So the bulls will want to see either an immediate bounce if nothing takes place over the weekend, and this Friday being the low, that would be the best case for the bulls. A more likely case for the SPX would, for instance, would be higher low set at about 43.50. As you can see, there's a lot of support right in here that was built in late January before the rebound started. So the bulls want to see that 43.50 level hold instead of going all the way back down here to about the 42.20 level where the low was. So if that takes place, the 43.50 low, if we get a solid bounce there, bulls are in great shape. If the 43.50 fails, there's still a chance that the 42.20 could be a double bottom here. So that would be the next thing for the bulls. And of course, the bears want to break both these 43.50 level as well as the previous low to be on their way to a real bear market, which we're still very far from a real bear market in the S&P 500. The NASDAQ, if these lows are broken, the NASDAQ will be in a bear market. So we'll just see about what's going to happen next week. Yeah, as we've already seen on the chart, every index closed pretty solidly negative on the week. The Dow benefited from a bit of a perception of value and relative, I guess, what do you call it, a safe haven demand that typically takes place during these uncertain times. And the NASDAQ was just hammered. Just a dismal performance in the NASDAQ this week. I think there's no momentum on the Nasdaq except for bearish momentum. It's just been terrible since November, and so we'll continue to see. At this point, like I'm personally more of a Nasdaq long-term bull. I think the outperformance that we've seen, and especially since 2015 to 2020, we've taken a breather. Since mid 2020, the Nasdaq is actually the worst performing index over the last 18 months. However, I think that's a temporary thing. I think the rate hike, if you look at the PE ratios, PS ratios, book value, all these things for the big tech companies compared to companies like McDonald's, Home Depot, Walmart, Nike that are, in the Dow and SPX and, really seen as these safe blue chip value stocks, Procter and Gamble, like all those, you'll see the big tech is actually pretty damn cheap, especially for the growth that big tech is still producing compared to those companies. But I think this is mostly a perception problem that will that will short term affect the NASDAQ. But over the coming 5 to 10 years, I fully expect the NASDAQ to get back on its track of outperformance, even if we have a worse overall market. Like I'm definitely expecting the 2020s and early 2030s to be much worse than the last 10 to 15 years. I think on average we can expect somewhere in the range of 2 to 4% on the S&P 500 and the Dow over the next decade, and I think the Nasdaq will be somewhere in the 4 to 6% range. So yeah, it's going to be bad for everything. I'm kind of a long-term, bear until this everything bubble kind of fully plays out, and then I think maybe a decade from now we'll start another big bull market. But yeah, there's going to be a lot of volatility. That's just now long-term predictions. But anyway, we don't really trade in the long term at Grizzly Bulls. We're more of a week-to-week traders. So let's look at the weekly economic statistics here. The big thing was the 10-year yield. It surged over 2% on Thursday, and then it fell a lot as bonds got their safe haven demand on Friday from the Russian stuff. So this is not looking as bad as it did on Thursday for the market. The but the Schiller risk premium in particular is very low, and the Cape continues to be high even with the sell-off. These numbers, for historical context, this is usually about 16 to 20, and it's 36. This should never really be below 1, honestly. Like this what this is the inverse of the Cape. So think of it as like the Schiller earnings yield, which would be a little less than 3%, and then you subtract the 10-year Treasury yield at 1.94%, and that's how you get this 0.8. This shows that equities do not have the risk premium on equities is very low, which means you're not getting very rewarded for taking the extra risk of investing in equities versus just investing in something safe like a 10-year Treasury bond. Sentiment, the big thing with sentiment this week is that neutral numbers has surged. So both the Bulls and the Bears lost people from their camp this week. I think people just in general are feeling, like anything could happen. We could see another rebound. We could see a last hurrah rally of the everything bubble. I think like Avi Gilbert, for instance, very famous on Seeking Alpha. He thinks that this is just, a correction into a 5,500 to 6,000 top, and then he's very bearish. He thinks kind of similar to me that after we hit some top, I'm just not sure if the 4,800 is the top, or we're gonna get another rally to 6,000. That's still up in the open there for me. But I agree with him and Michael Burry and a lot of people that overall the next 10 years are going to be very bad for the stock market. So anyway, that's kind of what happened this week. If you look at our models, we had some really good sell signals this week from the VIX, from all of our VIX models. But for free, you could have followed the VIX basic model, saved a lot of money on Friday. So anyway, that's all for this week, and we hope you have a great weekend.